Nimesh, given what is happening to the world, there are fears of deflation, growth has just got challenged. Is the bull market intact, or is that as well coming under question?
This is a market which last time when I had come to your show, I was talking about volatility, that how volatility will continue and volatility is going to affect. It's better to invest in funds where volatility is high and how they gain out of volatility. But now with what has happened and the markets getting corrected, we sometimes feel that this is the time where one should be. I don't know about bull markets or bear markets, but if you have reasonable expectations out of equity markets over a 3-year period, it is a good time to invest.
What do you think is a good time to invest despite the global problems? Because historically we have seen that every time a global reset button has been pressed, whichever time frame it might be, Indian markets have fallen in line with global peers and then recovered as well. What is your sense about this time?
That's why I said this is a great time. I will also refer to those 3 years, 2008, 2011 and 2013. We have always seen that whenever the FIIs have sold and Indians have bought, it has always made sense in the post. If you see, it has always made money. Whenever FIIs have sold, and I said with a 3-year paradigm, I didn't say for a short-term paradigm. Today I'm on your channel, I'm very happy to come on the channel 1 week down the line, 15 days down the line, when I'm proved wrong also. But in 15 days time you can go right, but I am asking you to go wrong. But in 3 years paradigm, I believe that earnings will come back. I believe there are a lot of companies where capacity, if you look at whether top down or bottom up, top down, India is a fantastic story. There are very few countries in the world where the macroeconomics looks so strong. There are very few countries in the world where interest rate is expected to come down. There are very few countries in the world where there is a latent demand in the country and where the capacities that have been set in have not been fully utilized. And there are lots of industries in the country which will benefit. India as a country will benefit out of low commodity prices, and there are a lot of industries which will benefit out of low commodity prices. And I think it's a great time to invest in India with a 3-year paradigm. So that's why I agree with you. There are a huge chance of me going wrong in the 15 days and 1 month span. Because there is an emerging market, I understand the risk that we face. Investors should be very clear. There can be a risk of an emerging market sell down, which has got nothing to do with India. When a ETF in the West or an emerging market fund in the West gets redemption, as part of their entire emerging market package, they will have to sell India also. So if that happens more, that is what has been happening in the last 20 days, 1 month. And if that continues, we can have more sell-off also. And markets can correct slightly from here also. So, but still, if you have to invest 100 rupees in the market for the 3-year paradigm, I would suggest that your investors should invest 20 rupees today.
Nimesh, you should never waste a crisis, and I'm completely with you. But let's understand the technical problem. And the technical problem is that foreign institutional investors of FIIs, they are the real owners of Indian stock markets. Foreigners are selling, and they're selling ruthlessly after a gap of 5 years. So can the domestic investors and can the domestic institutions digest and absorb so much of selling?
So that depends on the amount of offloading that happens from the West also. And I have not met anybody who has got any indications of the same. Even if you believe around $2 billion can be sold by foreigners tomorrow, I cannot say that till now the flows have been positive. In fact, whenever markets have fallen, we get our maximum inflows. The inflows into our funds goes up big time the days market falls. So that we are seeing a continuous pattern that inflows increase in the funds. To what extent will we be able to take it? I am not sure, because if there is a sell-off by foreigners, market will correct to a certain extent. But if one set of foreigners, if the ETF sell today, I am very sure there are a lot of hedge funds sitting in US. At a certain level, they will be the entrance into the market. I had come on your channel in October 2013 when we had given a big bull call on equity, saying that, thumping the table, we had said that invest in equity. The reason we had done that is we had understood that the valuations are very reasonable, and we had met a lot of hedge funds in US who were saying at that point of time that market falls below 19,000 and we will be the ones to enter the market. We were very clear that they were the vulture funds who wanted to enter the market as soon as India comes near 18,000, they were entering the market. I think at that time the dollar was also touching 66. So their thesis was dollar going beyond 66 and market falling below 19,000, they will enter. So foreigners, if the ETFs or the emerging market funds exit today, and if the local funds are only able to absorb some amount of the sales that they do, and even if the market corrects, I am very sure there are another set of investors who will be opportunistic investors who will be coming on every correction that happens in India. So market has even the foreigners investing in India has a way of correcting out the outflows. So I am again saying I don't know what will be the kind of outflows in the next 6 months, next 1 month, but I am asking people to invest with a 3-year paradigm.
Right. So Nimesh, how would you assess the impact of the drop in commodity prices for India? I mean, on paper, this may be great news for the macros, but this is surely bad news for PSU banks and NBFCs who have large exposure to metal companies.
But that the market has already corrected, whether the commodity metals are concerned or anything related to those prices that have the market has given the negative impact on those commodity stocks. Right, the market has given a negative impact. The banking index has corrected almost 20% today. So market has corrected itself wherever it had to correct. But a lot of upside that can come out of the decrease in commodity prices in various sectors, we'll see that upside also coming in the earnings over the next 2 years. And ultimately, we are believers of cycles. One of our fund managers has gone into commodity stocks also. We have got various kinds of funds and various different fund managers with the different thought processes. So if one of my fund managers who plays contra has gone into and has taken metal stocks also in that, because he is a firm believer that cycles will turn back and over the next 2 to 3 years you will again see some of the commodities prices coming up. So he has taken his bets on that. So there are various ways. One is the user industry benefit will come over a period of time. And second is the commodity stocks itself have got corrected so much. There is one oil company where you can actually, there is more cash in the company than what the share price suggests. The cash per share is more than the market price of the company. So that's the kind of opportunities that are available. So one has to bottom up stock picking in each of the sectors will help today.
In this current turmoil, large cap stocks have corrected more than the mid cap stocks. Now, why is this happening? Because historically it starts with large caps, but mid caps fall much more eventually. Do you think that will happen now?
If you see since October 2013, where a lot of mid caps were available at a PE of 4 and 5, today the situation is such that the mid caps are much highly priced than large caps in terms of PE ratios. Now, when we see who's buying large cap and who's buying mid caps, to a certain extent, large caps have been corrected because the foreigners have sold over the last 1.5 months. So because of that, the large caps have corrected faster. To a certain extent, we at mutual funds also have helped in the mid caps not falling as much, because if there are inflows in mutual funds or the local markets are giving inflows, and if we are more investors of mid caps as an industry, I'm not talking about me as a company, we have taken a overweight position on large caps, and as much as possible we are into large caps. But I believe that a lot of flows have come into mid caps, where it has gone into mid cap stocks. So there is a buying support available for mid caps, where there is a selling pressure on large caps. That is why large caps have corrected more than mid caps. That's why my investment thesis is invest in large caps today and not in mid caps, because I feel there is more risk in mid caps today than large caps.
So do you think, Nimesh, that mid-caps as a category could correct because it hasn't corrected as much as the frontline indices, and it clearly doesn't seem to be on the preferred list of buyers?
Mid-caps are correcting and they will correct going forward. When the flows in the mutual funds get slightly subdued, then mid-caps can also correct to a certain extent. I would put my investments into large caps today and not in mid caps, because I see more risk in mid caps today. And some quality mid caps are available at ridiculously high prices. We to a certain extent don't understand that when a company where you get a consumer company which is available at 75 and 70 PE, in fact we have gone wrong on that a lot of companies which were at 40 PE are now at 75 PE. And despite the current fall, that company remains, and the company is not showing, showing a growth of 25-30%. A good company, so quality mid caps are valued very high and they have not fallen as much as large caps have fallen. So I would be very cautious on those counters. Quality mid caps. They are getting buying support with inflows coming into mutual funds.
So Nimesh, where are you picking your spots in this market? You don't like FMCG. You think Indian pharma stocks are expensive. So what is left in this market where earnings are decent, valuations are reasonable, and you're happy to buy them?
One is the area that we have picked up is auto. Second, auto we believe is it's fairly priced for the growth that we expect over the next 3 years in auto segment, especially four-wheelers. Private sector banks I already mentioned why we believe that they are gaining market share, and over a period of time their retail franchise is too strong and will take us and they will be able to do well in a country like India. Third place is the utilities that you would have seen even since you study our portfolio very well. We look at interest rate drop as a theme. If interest rates are going to reduce in a company, companies with a reasonable, there are some utilities in this country which are available at a very cheap level. So I feel utilities which are nothing but a bond, because a 15% CAGR is more or less ensured in those utility companies. Say a utility which is there in power distribution, right? You know what it is going to earn over the next 2-3 years. Still it is available cheap. When the interest rates go down, they will benefit out of it. So I feel that's a good play. And another play that we have played in the last since the last time one of the technology after the last quarter results of last year, we had given a call on technology, and we because we believed in a strong dollar, and we are still sticking to our call. It has given good returns. It has given almost in the last 3-4 months, technology has given almost 12 to 13% return, and we are still sticking to that call of ours on technology. So I said technology, banking, auto, utilities.
Okay. And by the way, before I come to my next question, just want to show what pharma is doing, because that is not doing too well. We were talking about few stocks which are doing well, but pharma has again gotten thrashed today. So the Strides, Ajanta Pharmas, etc. of the world are all coming down in a hurry today. Wockhardt is down about 2.5%, Strides is down, Ajanta Pharma is down. Exporters at large are just looking slightly wobbly. Nimesh, do you think this, there is a bit of an underperformance right now, but do you think the broad outperformance in IT and pharma stocks might just continue? And will the premium stay, or do you think that will only contract?
That's where we believe that to a certain extent these sectors are slightly highly priced, especially pharma, where we believe it is there might be some bottom up ideas, but overall we feel that sector wherever, and we have tried to stay away from that, because from here a company which is already sitting on a 40 or a 50 PE, we as a fund house are not buyers into those stocks. So we have always stayed out from that, and we have paid a price in the last 1 year for staying out of that. But we believe over a period of time, we are convinced that you have to make money by buying relatively stocks which are cheaper than their intrinsic value. We are value investors and will remain that way. So some of the sectors that you mentioned, the pharma sector, I don't think we are present to that extent, and I don't think going forward they can give that kind of returns, especially some specific stock. I'll not talk about sectors, but companies with very high PE ratios, we are uncomfortable. Though market is going and buying those stocks, we are uncomfortable. It is not sustainable.
So are financials looking cheap after the recent bout of correction, or do you think there's some more pain in store?
Yeah, I would still go for a business which is acquiring market share. And I will today invest my, I would be an investor of private sector banks more than in public sector banks, because I believe they have got a robust business model which can take on retail big time. If the retail business of this private sector banks will increase, I think there are NBFCs, there are private sector banks which I will invest in.
So Nimesh, let's get some closing comments from you. Let me summarize our today's interaction. You are of the view that this is a good time to put money to work, and rather than running away from the turmoil, one should be participating in it. And if you're buying right now, your basic assumption should be that in the next 2 to 3 years, equity markets will give you a sizable return.
Right, that's exactly, because there are bottom-up companies where I believe that there is more capacity that the company capacity utilization can be increased. With that, the operating leverage will pick up, and over the next 3 years, their results will be better. and they will be able to, I think there are lots of companies where profits can go up as high as 50% in the next 3 years. And that's the companies that we are paid to select for you.